What's up everybody, Gen X Dividend Investor here. In this video I'm going to compare the performance of the Dividend Aristocrats versus the SP500 so we can see how decent dividend stocks are doing when compared to the overall market. So if you appreciate stuff like this, then please hit the thumbs up button, subscribe if you haven't yet, and click that bell notification. Okay, I put all 64 of the classic Dividend Aristocrats into a spreadsheet and found some really interesting insights in the data. I used PortfolioVisualizer.com to figure out how various stocks did over varying time periods. I'll include a link to Portfolio Visualizer in the description below. Once you're on that site, you can click on Backtest Portfolio. So let's say I wanted to look up the last 10 years of J&J's performance. I'll first set the time period to month. And since I want to see how J&J did over the last decade, I select April of 2012 as the starting date and April of 2022 as the end date. I didn't use May, even though I'm doing this video in May, because the free version of Portfolio Visualizer restricts you to the previous month. They default $10,000 as the starting amount of your portfolio, which is fine to keep it at. Then I have rebalancing set to no, and then make sure that reinvest dividends is on yes. I recommend you spend some time familiarizing yourself with all the options. Okay, and I want to compare J&J to VU, so I'll click on Benchmark and then I'll select Specify Ticker and I'll type in VU, which means I'll be comparing whatever portfolio I create to VU, which is basically the SP500. Then we come to the section where you put in your stocks. The way it works is you list all your stocks in the first column, and then in the second column you list the percentage of each stock in your portfolio, and all your percentages should add up to 100%. It also gives you multiple portfolio columns you could use if you wanted to compare one portfolio of stocks against another. So in this simple case, I'll just put in J&J as my one stock, and I'll state that it's 100% of my portfolio. Then I click Analyze Portfolios. We see that we end up with a final balance of J&J at about 36.2 grand versus the SP500, which would have taken us to 35.6 grand. That means that J&J's total returns slightly outperform the market over the time frame we selected. We also see that Portfolio Visualizer lists the CAGR, aka the compound annual growth rate, for each stock. And in this case they're talking about the annualized returns if you add in stock appreciation plus dividends. Normally we think of dividend CAGR, but it also applies towards total returns for a stock. We see that J&J has a 13.61% overall CAGR, which means it returned 13.61% annualized over 10 years, i.e. it returned 13.61% per year on average for 10 years. Sweet. And we see that the market had an annualized return of about 13.44%. You can also hover over the eye icon next to the final balance numbers and the CAGRs to see inflation-adjusted returns. Okay, now let's pretend that we want to model a portfolio that has 4 stocks in it to see how it's done in the last 10 years. So let's put J&J at 30% of the portfolio, Procter & Gamble at 10%, Realty Income at 20%, Caterpillar at 40%, and we'll keep all the other options we had from before. Now when we analyze the portfolio, we see that our $10,000 grew to $30,389 in 10 years, which means it had 11.65% annualized return and thus underperformed the market, which we already saw had a 13.44% annualized return. Of course, realize that just because a stock has had a good historical return doesn't mean it will continue to do so in the future. Before you ever invest in a stock, you should understand why a company has performed well historically, as well as create a thesis as to how you think they'll perform going forward. Okay, now that you get how Portfolio Visualizer works, let's jump into a spreadsheet I created where I summarize the performance of all the Dividend Aristocrats. I started by sorting this based on worst to best in terms of year-to-date performance. So I have the ticker, the company name, the sector, the year-to-date performance up until May 1st, the 5-year annualized return, the 10-year annualized return, and beta. The first row of the spreadsheet has the SP500 data, which is called ticker INX, and we see that year-to-date the SP500 is down around 13%, and that its 5-year annualized returns are 13.62% and its 10-year annualized returns are 13.63%, and its beta is 1 as it represents the market. Okay, so the worst performing Dividend Aristocrat this year is T. Rowe Price, which is down 36.88% for the year, but has an awesome market-beating 5-year annualized return of 15.02% as well as a market underperforming 10-year annualized return of 10.29% and a beta of 1.34. Remember that beta is a way of measuring a stock's volatility compared with the overall market's volatility, and that the market has a beta of 1. Stocks with a beta greater than 1 are more volatile than the market, which means they generally go up more when the market goes up, and conversely often go down more when the market goes down. So in T. Rowe's case, it doesn't surprise me to see it has gone down more than the SP500 because its beta is quite a bit above 1, So in this down market, it's gone down more than the market. After T. Rowe, the next worst performing for the year is Stanley Black & Decker, which has fallen by 36% this year and also has a higher beta at 1.37. That being said, SWK is looking pretty compelling purely from a stock price perspective right now. Then the third worst performing Dividend Aristocrat this year is West Pharmaceutical Services, which is down almost 33% year to date. But West has an astronomical 5-year annualized return of 28% and an even more amazing 10-year annualized return of 31%, which means it outperformed the market. Nice. It'll be interesting to see how these companies perform if we have a recession. I say if because we are not yet officially in a recession right now. Goldman Sachs came out 2 weeks ago and published an article saying that a recession was not inevitable. Some experts say that we will go into a recession due to the Fed raising rates, but UBS came out a couple weeks ago and said that they do not expect a recession due to rising interest rates. But you can find other big investment firms like Deutsche Bank that said that the Fed has never been able to correct even smaller overshoots of inflation and employment without pushing the economy into a significant recession. Thus, that basically means that they're saying that a recession is incoming. Personally, I think it's reasonable to say that it's looking more probable that we'll go into a recession, but the fat lady ain't singing quite yet. I mean, she's on stage and is warming up, but she hasn't officially started singing. Recessions used to be defined as 2 consecutive quarters of economic decline, i.e. 2 consecutive quarters where the GDP was negative. Negative growth is a decline in a company's sales or earnings, or a decrease in an economy's GDP during any quarter. GDP stands for Gross Domestic Product and is the total dollar value of all goods and services produced over a specific time period by peoples and businesses. We care about GDP because it gives us insights into how an economy is performing. If GDP is growing, then that's a good sign that the overall economy is improving, which usually means employment is increasing as companies hire more workers and people have more money to spend. When GDP is shrinking, like it did during the global financial crisis, employment often also declines. And when we don't have growth, then economists know that the likelihood of a recession or depression increases. Then recently they changed what they consider to be a recession, and instead of just saying it's 2 consecutive quarters of negative GDP, it is now when we have a significant decline across the economy lasting more than a few months, looking at GDP, income, employment, production, and retail sales. Now, I opened this video with a famous Paul Samuelson joke quote, which is that the stock market has predicted 9 of the last 5 recessions. To me, that means that even though experts often predict recessions based on how the stock market is doing, the reality is that they are wrong more often than they're right. You can't just look at stock market metrics to accurately predict recessions. I read that there have been 14 bear markets since World War II, which means that we have a bear market every 5.5 years on average. A bear market is a prolonged period of price declines in a stock or entire market, usually of 20% or more from a recent high. About 50% of bear markets have led to recessions within 12 months. What often happens in recessions is that people buy less cars and houses and such, and more people unfortunately default on loans than they normally do, and all of that is usually negative for banks and financials, which is why they tend not to do well in recessions. Anyways, what we see so far in this data is that all the worst performers in this down market all have betas greater than 1, until we get to Expeditors International of Washington, which has a beta of 0.86. Expeditors is a freight and logistics provider. The first Dividend Aristocrat that I own in my personal portfolio doesn't show up in this sorted list of worst performers year to date until the 27th stock, and that's Colgate-Palmolive, which is down about 8.7% for the year. I've been fortunate that in the stock market, where so many non-dividend investors are talking about how terrible things are, my portfolio is only a few percentage off my all-time highs, and that's even with me withdrawing all my dividends and using them for expenses. Of course, I lost over 50% of my portfolio from peak during the dot-com crash, so I've taken my lumps in the market, and I guess I'm just getting lucky right now. I fully expect to see my portfolio go down materially if the entire market crashes hard, but for now I'll just keep enjoying as my dividends flow in, regardless of what the stock market does. So I see that 22 aristocrats have done worse than the SP500 year to date, which means that 42 have done better. Overall, the aristocrats are down 5.66% year to date, as opposed to the SP500, which is down around 13%, which is what I'd anticipate given that their overall beta is 0.87, thus they should lose less when things go down. However, you can also see that the overall Dividend Aristocrat 5-year annualized return is 12.5%, which underperforms the market by about 1% each year. And we see that the overall Dividend Aristocrat 10-year annualized return is 13.1%, which also slightly underperforms the market, which had a 13.63% 10-year annualized return. That's why I always recommend that you buy when things are cheaper than their intrinsic values, so that you can outperform these average numbers. So I think you can do fine if you just keep DCAing into a diverse portfolio of quality stuff, even when things are expensive. but your overall returns will obviously be much better if you can buy when things are cheap. Okay, now let's sort this spreadsheet based on the best performing aristocrats year to date. So the best performing one this year is ExxonMobil, which is up an astounding 40.88%. Wow. I'm long Exxon, and I'm long Chevron, which we see at the number 3 spot of best performers, with it being up almost 35% for the year. Leave me a comment telling me what your best performing dividend stock is year to date. Okay, the second best performing dividend aristocrat this year is Nucor at positive 36%. When I look over the rest of the list, I see some others I'm long in, including AbbVie, which is up 10.6% year to date, as well as good old boring Coca-Cola, which is up about 10% year to date. I say boring in air quotes because I love companies like Coke. Now, if we average the beta across the 10 best performing dividend aristocrats in this list, we get 0.83. So again, that makes sense. The best performers have low betas in down markets. Okay, now let's sort these aristocrats by sector to see what patterns we might find. So now we see that all the consumer discretionary stocks are red, which makes sense because a discretionary item is one you don't have to have but is nice to have. So as people get more conservative with their money in down environments, they sometimes avoid spending as much money at some discretionary companies. You can also see that Target and McDonald's are the best performing aristocrat consumer discretionary stocks, which makes sense intuitively as people spend money at both those places pretty much regardless of what's happening in the economy. And we see that Lowe's and VC Corp are the worst performing discretionaries, which also makes logical sense since Lowe's is something that people can sometimes minimize spending on when times are tight, and the same is true for VF Corp, which has some higher end clothing brands like North Face and Timberland and Eastpak and such. One good thing about Lowe's is that people will still go there if they need to replace or fix things. Okay, now let's look at the next sector in this list alphabetically. So consumer staples are up next, and we see about half the stocks are green and half are red, and overall they average about 0, aka on average they've gone sideways for the year, which also makes sense that they're holding up better since staples are defensive stocks that investors move to in weak markets. So I'm long in some of these like Coke and Pepsi, Procter & Gamble, etc. Then we come to the energy sector where we only have 2 aristocrats, both of which I'm long in. And it's good to know that while they're doing amazingly this year due to supply constraints in the war and such, that their long-term performance is not so hot. And then after energy we come to financials, and overall I find that financials are down 9% for the year. After them we have healthcare, and overall we find that healthcare is down about 3% for the year, which is doing better than the overall market. Then we come to industrials, and we find that overall the industrials aristocrats are down 13% for the year. After them is technology, and the 2 infotech aristocrats average 5% down for the year. Then we see that the materials dividend aristocrats are down an average of almost 9% for the year. The 3 real estate aristocrats are down about 11% for the year. And then the 3 utility stocks are about flat when you average them for the year. So overall we can see that the dividend aristocrats are holding up better in this down environment than the overall market. I love owning high-quality dividend stocks that help me lose less in down markets, and even when things are down, the good companies keep paying you passive income. I found that holding a diverse basket of decent dividend stocks allows me to weather the storm when particular sectors or stocks or the whole market is doing poorly. And if you're a long-term investor, then you don't stress when your stocks are down because you aren't selling. You're just holding, and you know that eventually the market will turn around. Think about oil. Rewind back a bit and everyone was hating on oil and you couldn't sell it if you wanted. Remember that? Tankers were trying to unload oil and people were treating it like poison or something. You can learn a lot about investing from that experience, including that the world isn't quite able to free itself from carbon fuels. They're simply too big a part of the global economy. So no, oil isn't dead. And their management teams are smart enough to diversify into other energy sources. Like Chevron announced in February that it would buy biodiesel maker Renewable Energy Group in an all-cash deal valued at over $3 billion. Chevron has set a target to cut operational emissions to net zero by 2050. Exxon is also investing a lot of money to enable a lower carbon future. Obviously, their management teams want to create companies that last for generations, so they allocate capital in ways that will benefit their shareholders accordingly. I don't think it makes sense to demonize oil companies, especially by people who use their products, which is literally everyone out there. Anyways, I own 12 of the dividend aristocrats in my 27 stock dividend portfolio. You can see all my positions in my other videos. 6 of those are red year to date in Colgate-Palmolive, Realty Income, McDonald's, Procter & Gamble, Kimberly-Clark, and Pepsi. And then 6 are green in Johnson & Johnson, Caterpillar, Coca-Cola, AbbVie, Chevron, and Exxon. So if I held those stocks in equal amounts, then I'd be up 7% year to date. And fortunately, my J&J, Exxon, and AbbVie positions are all in my top 6 positions overall, helping push my portfolio up. At the end of the day, I find investing in Dividend Aristocrats as a key pillar of my portfolio, and I encourage people to buy when things are cheap. And don't obsess about short-term performance of a stock or your portfolio, because what you really care about is how they do over decades. But it is interesting to analyze information like this over varied periods of time, as the more you learn, the more you can improve. Okay, now I'd like to shout out my latest Patreon aristocrats who have signed up since my last video. So thank you Debbie, thank you Genove, thank you El Mayo for signing back up, thank you FatPat5000 who signed up for a full year and so we got the 10% discount, and thank you Tony Glenn for also signing up for a full year. Tony has a YouTube channel which I'll link to in the description of this video, where he teaches beginner musicians how to play some of his favorite Springsteen songs on the guitar and harmonica. I notice he hasn't been posting too much lately, so maybe if you show him some love and subscribe, he'll be motivated to put up more videos. Anyways, there are limited Patreon Aristocrat spots remaining, so sign up now if you're interested. Aristocrats gain access to my dividend portfolio tracker spreadsheet, which I use in lots of my videos, and they get special access to various private channels on my Discord, including one which lets you watch my videos before I release them publicly on YouTube, as well as lets you vote on which thumbnails I should use. Finally, I urge everyone to join my free Dividend Discord chat server, which has thousands of dividend investors on it from around the world. Please hit the thumbs up button, subscribe if you haven't yet, and click that bell notification. Thanks for watching, stay positive, and I'll talk to you again real soon. I am not a financial advisor, and these videos are for entertainment, inspiration, and educational purposes only. Investing of any kind involves risk. I am only sharing my opinion with no guarantee of gains or losses on investments.